Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting critical minerals and we're going to be balancing out the supply demand imbalances that it seems like we are hearing about almost day after day, at least week after week, for a number of these critical minerals. With Matt Badiali, editor of the New Energy Investor, published under the Mangrove Investor, which I will link to in the show notes. Now, Matt, it's one thing we were talking about off mic is look, critical minerals and all the different drivers behind demand, EVs, AI data centers, solar panels, everything. There's so many different demand factors that we are hearing about where they're saying we need more of these critical minerals to be mined, and we're either not discovering them fast enough, we're not building mines fast enough, all these different factors that are coming into the supply side where look, we've all seen these charts that say we are at a deficit and that deficit's only going to get worse as we move forward. That's why you should be investing in critical minerals. Matt, I feel like I've heard this argument before, so I have to ask you, is this demand argument overblown in your eyes?
No, it's not overblown. It's just slow. That's the truism of these of markets in general is that they move at their own speed. And when investors are, especially in the modern era, investors are very impatient and they don't want instant gratification. They want it yesterday. And so we are grinding through these supplies and we're growing demand. But the thing that I see in this and is that demand is much more rapid than the ability of supply to come online because you have the supply chains that are old. I mean, you think about mining supply, the way that mining works, it's an old system. And when prices are low, which they have been for the last few years, there's been a lack of sustaining capital. And I have to tell you, coming from the oil and gas world, if you don't put money back into your oil fields, eventually your oil fields dry up. And if you haven't been spending money on exploration, there's nowhere else to go. So before kind of the shale revolution, we were talking about peak oil because demand was rising, supplies were looking grim. We really couldn't figure out where the new barrels were going to come from, and the oil price hit $140 a barrel. And even after the shale revolution, and even after the United States rocketed to the top of global oil producers and we're producing more oil than we ever had before, the oil price still really flirts with $100 a barrel frequently. And we just can't, like most of the investors today, you can tell them the story of when oil was $15 a barrel and nobody thought it would go to 20, but they really can't comprehend it. But if you want to see what a lack of investment and massive demand can do to the price of a commodity, you just need to look at oil and realize that the markets have rationalized 70, 80, $90 a barrel oil when honestly, $25 or $30 barrel oil was almost unthinkable. And it wasn't that long ago, just a couple decades.
Well, Matt, when you think about oil and the price elasticity that you're going over, it's also different than hard rock mining in that you literally can drill a hole in the ground and have oil coming up within an hour. You cannot do that in hard rock mines. And the other issue is the land disturbance that hard rock mines, especially open pit mines, cause globally has a lot of social pushback, a lot of permitting issues, and the scale of getting into the ground and getting down to even where the ore is and getting rid of the overburden sometimes is a years or even a decade long process as opposed to just poking a hole in the ground. So do you think with copper, with tin, with rare earths, with nickel, that there's going to be a moment of reckoning where the price elasticity has to stretch even further than people were expecting?
Yes, I do. Absolutely. I think, there is enough kind of push down on that side, on that demand side of the scale. What will you be willing to pay for AI? Because if you don't have copper and tin, you don't have AI because you don't have the data centers that you need. What will you be willing to pay for the 10 inputs to EVs or to solar or nuclear or hydro, or wind, because you're going to need to pay up for the metals that go in there. I think that, certainly with oil, when we got to these astronomical high prices, that's what drove the innovations, because you had capital available to do crazy things like crack shale with high pressure fluid, which honestly, I mean, I was a front row seat for the shale revolution, and we drilled through those rocks. We drilled through shales the entire history of the oil process, the oil business. We drilled through the shales to get to the sand bodies because they were your conventional oil fields. And it took an engineer and high oil prices for them to really innovate. And I mean, this was so far out of the box thinking you couldn't even see the box from where they got to with shale. And it also pivoted on the computing capacity. When you think about where computers were in the 60s and 70s versus where they were when the shale revolution happened in 2008, 9, 10, it was just incredible. And then you fast forward to today, and my iPhone is a stronger computer than all of my other computers added together. So we need an incentive in mining to really innovate, and we won't get that until prices, go parabolic. And I do think that we want AI and we want EVs enough that we will allow the supply demand curve to get so out of whack that prices have to go astronomical. They have to go really high.
So, Matt, is that the big change then? Because as I said, you even chuckled when I said, why is this time different from these other times when we hear that, look, we're going to run out of certain metals because of this or that factor moving forward? Sometimes we do see innovation, technology innovation that lowers the overall need for certain metals or certain energy sources. Is this time just different because there's a number of different factors playing into this overall demand? Or why is this time so different that it is going to cause sustainable price spikes? Or will they be sustainable price spikes for these metals?
No, I don't think this is different at all. I just think that we haven't hit the inflection point. So, yeah, the history of commodities is exactly what you said. You have valleys in price where people kind of give up on it. They don't care about it anymore. They don't look for any more. Really, it's funny because I was just talking to a guy about a copper mine, and, they didn't explore around the copper mine. And he was kind of lamenting the fact, why wouldn't they have explored? Why wouldn't they have explored? And I'm like, because copper price was low. That was when you're just trying to keep your business alive. You didn't have money to explore. You didn't have money to innovate. It takes higher prices for you to go, well, maybe we should drill underneath our existing mine. I mean, it's only down 300 meters. What happens if we look 1,000 meters? And is that economic? So, you have these periods like with oil, where oil prices go up to $140 a barrel. The innovators crack the shale code, and the next thing you know, we're absolutely flooded to the point where the oil prices are back around 20 bucks a barrel. I was in Abilene. Oil price was around $70, somewhere around there. And it was just as the Permian Basin was really starting to rip. So oil prices had come down. And I was talking to two bankers, and they were lending money to oil companies. And basically that's how you did it. You borrowed money from the bank and you secured the loan with your production. And their base case, their Armageddon end of the world oil price was $40 a barrel. And it got down to 20. And those guys don't write oil loans anymore. So, the market, that's just how the commodity prices work. You substitute or you innovate, right? There's no substitute for oil until we were able to figure out how to make lithium batteries that could drive a car for a couple hundred miles. Now we're getting competition from electric vehicles. So yeah, I never look at commodity prices and see an uptrend and extend it to forever. you know that you're gonna go to a point where people will stop using it, or someone will find a substitute, or there'll be an innovation. So they're cyclical. But I do think that you can rebase your prices. We've seen that with oil, we've seen it with copper, we're seeing it with gold, where the expected price, or kind of the long-term flat price, is substantially higher than it was 10 years ago or 20 years ago. And I absolutely think you're going to see that in lithium. I think you're going to see that in nickel. I think you're going to see that in copper. And I definitely think you're going to see that in tin.
Well, and Matt, there are automakers that have come out and said they're going to decrease the amount of copper in EVs. And so they've done all these components, looked at how can they reduce it, and they've looked at reducing other metals. And Benchmark Mineral Intelligence just put out a study saying that there's going to be a 177% increase in copper demand in EVs, even despite, and this is through 2030, even despite reducing all of the components' copper supply. And they also mentioned in that same article that last year, I think we produced 22 million tons of copper, and they project that this year, 2024, we need 28 million tons, and that we're going to need a 3.9 to 4% more every single year the rest of the decade. So when you look at those numbers, again, it's not like the oil industry where you can just say, okay, guys, let's get more copper. There is no way to produce enough copper to meet those demands. So for people that are doubting this narrative, if you spend any time researching the demand side of this equation, then math doesn't work.
Yeah, I mean, with things like copper, like even Nikola Tesla couldn't defeat the laws of physics. If you want to make an electric motor, which is what every one of these cars have, you have to use copper, because there isn't another metal that you can make the motor out of. If you could make it out of aluminum, but it would just be too big and impractical to put it in a car. So yeah, I mean, you can reduce all you want. It's like tin. Okay, what are you going to substitute tin solder with? Silver? Well, that's not going to work. I mean, that's not economic. So yeah, I mean, you bump up against these real, where, with oil, when barrel oil hit $140 a barrel, people stayed home. They started carpooling. You had, it's such a massive impact across all of the economics of your everyday life, that people really had to contract, and it had a dramatic impact on the global economy. So it needed that innovation. There had to be the innovation. And I think you're going to run into that with copper. It is as important to our modern lifestyle as oil was to, kind of the pre-2020 life. That's just the way it is.
So, Matt, I guess we're all waiting for the price to react, to really explode higher, then to make us all money. But how do you think investors should play this? What sort of stocks do you look for if you do buy into this narrative and you think it's coming in the relatively near future, so you don't need to sit around maybe 10, 15 years in positions that aren't going anywhere? If it's happening in the near term, what are some of the best ways to play this sort of a narrative shift?
Yeah, I mean, it depends on what level of risk you want to take. But, I think we've talked about it on previous pods where Shad talked about the big copper ETFs. There are lots of baskets of metal producers out there that are really kind of that gentle entry into the sector, that will, with a basket of these metal stocks like the copper ETF, you reduce your exposure to individual company liability and increase your exposure to kind of that producer premium that you get. So the producers, when you get the rising price of copper, it impacts revenue, it increases their profit margins, and those stocks react more than just a higher percentage than just the commodity price itself. That's the way I like to do it. The other way I like to do it, if you want to take on a little more risk, you spend some time and find what I like to call the oceanfront property, the deposits that you have to own. So there are these just tremendous new deposits. Ivanhoe is one that jumps to mind. They're Kapushi and Kamoa. I might be saying that wrong, but they're just the best new copper, cobalt, deposits in the world, right? So those are the ones, and there aren't that many, And so I think if you went through all the metals and spent time digging, you might come up with 10, and that would be across copper and nickel and silver and gold and lithium, where you have to own these things. And that's a great way. You're going to take on a little bit of company risk, but you're going to own the assets that are the best assets. And we saw this same kind of story play out in that 2009 to 2011 run in the Athabasca Basin, where if you bought these absolute rock star uranium deposits that were being developed there, you made a fortune in those stocks.
All right. So a lot of opportunities out there. Again, we just need, I guess, price to move. We're hearing all these articles of how much of a shortage and deficit we're going to have for some of these critical minerals. And look, there's a lot of companies putting a lot of money to work at continuing to build this sort of narrative shift out. But when the underlying metals respond and just how much they respond, there could be opportunities there. It's an interesting topic, Matt, and I'm sure we're going to be talking about it for a little while as we closely monitor price and see what companies can do and what other sort of innovations we have, hopefully within the mining sector. Again, Matt Badiali, editor of the New Energy Investor, published under the Mangrove Investor. Click that link in the show notes to learn more about the New Energy Investor. Matt, always great chatting with you. Thanks for your time today.
Thanks, guys.